Okay, let's unpack this. We are jumping into a deep dive today, really focusing on a specific trading strategy, how some traders try to get these, well, what are often called sniper entries.
Right. And we're digging into the ideas from a specific YouTube video. The perfect entry strategy that will 10x your results by GFAX. That's our source material here.
Exactly. So, our goal really is to explore the main concepts that video talks about. Things like supply and demand zones, this technique it calls zone refinement, and also how looking across different time frames, multi-time frame analysis, ties into aiming for those super precise entries.
Yeah, and it's important to stress, like you said, we're focused on understanding the ideas presented in the source. This isn't trading advice, just exploring the concepts.
Absolutely. So the video, it seems, grounds everything in these foundational ideas of supply and demand zones. Based on how the source explains them, what are we actually talking about?
Okay, so the video defines a demand zone as essentially an area you see on the chart where the price kind of consolidated, moves sideways right before a really strong, sharp move upwards.
Right, like a pause before the launch.
That's the picture it paints.
Yeah.
And on the chart, the source says you visualize this with a box. You draw it using the last candle that formed just before that big upward impulse really took off.
Okay.
The thinking behind it is that this zone represents where, significant institutional buying probably happened before.
And that matters because it's a level where the big players might show interest again if price comes back.
Precisely. It's seen as a sort of discount price for whatever asset you're looking at. The expectation, or the theory, is that if price eventually pulls back down into this area, that same institutional buying interest might kick back in, potentially pushing the price up again.
So the strategy derived from that is looking for buy opportunities on a retest of that zone.
That's the core idea for demand zones.
Got it. And I assume the supply zone is just the opposite.
Exactly, the mirror image. A supply zone is an area of that sideways movement, that consolidation, that happens right before a strong downward move. And again, you'd box this area using the last candle just before that downward impulse. But this is supposed to represent where institutional selling occurred previously.
So a premium price level this time.
That's the term used, yeah.
Yeah.
A premium price. And if price climbs back up into this zone, the expectation is that the selling pressure might reappear and drive the price back down. So you'd look for selling opportunities there.
Okay, so the fundamental idea from the source is pretty straightforward. Find these areas of past institutional activity and anticipate potential reversals if price returns. Now, the source then brings up an interesting point. Using these zones just off a higher time frame, like maybe a 4-hour chart, it can lead to decent trades, sure, but maybe not the absolute best ones. What's the difference the video draws between a good entry and this sniper entry idea?
Well, yeah, if you spot a zone on, say, that 4-hour chart and price comes back to it, taking a trade right there based on the whole zone, that's presented as perfectly valid. It can be profitable.
Makes sense.
The video even shows an example, a trade from a 4-hour supply zone that offered, I think it's a 1.9 risk reward.
Which, just to clarify, means for every dollar you risk, the potential gain is $1.90. That's, a solid potential return.
It is, absolutely. And there was another example on NZDPY, a demand zone trade from the 4-hour, that offered something like a 3.08% potential return. Definitely profitable trades.
Aye.
But the argument the source makes is that these entries, while good, aren't necessarily sniper entries. The key difference is that the potential reward you get for the amount you're risking, that risk-reward ratio, could potentially be improved, significantly improved.
Okay, and this is where zone refinement comes in, the technique the video introduces as the way to get those sniper entries. How does this actually work, this refinement?
So zone refinement is all about boosting that risk-reward.
Yeah.
You start with your zone identified on the higher time frame. Let's stick with the 4-hour example.
Right.
Then the technique involves zooming in, looking inside that larger 4-hour zone, but on a lower time frame. So maybe stepping down to the 1-hour chart, for instance.
Ah, okay, so you're examining the price action within the bigger zone's boundaries, just on a faster chart.
Exactly. And when you do that, you often see the price action that actually formed the original zone in, well, much finer detail. This lets you pinpoint smaller, more precise zones that are contained within that larger original one.
Finding the smaller box inside the bigger box, basically. What's the real payoff for doing that? Why bother?
The huge benefit, according to the source, is that by using this smaller refined zone from the lower time frame for your actual trade entry, you dramatically increase the potential risk-reward for the exact same trade idea.
Wait, so the target stays the same? The overall reason for the trade is the same?
Yes, exactly. Your target, your initial stop-loss logic, it's all still based on the higher time frame analysis.
Duh.
But because your entry point is now much tighter, much closer to where you anticipate the turn.
The distance to your stop is smaller relative to the distance to your target.
Precisely, which massively boosts the RR.
And the video had some pretty dramatic examples of this, didn't it?
It really did. That 4-hour supply zone trade we mentioned, the one that was 1.9 RR, by refining down to find a 1-hour zone inside it, the potential RR jumped to 6.25.
Wow. Okay. So risking $1 to potentially make $6.25 instead of $1.90, that's a huge difference.
It is. And the NZDPY demand zone example, that went from around a 3.08% potential return using the whole 4-hour zone up to about 5.58% potential return just by using a refined 1-hour zone within it.
So nearly double the potential return without changing the core trade idea or where you think the price is ultimately going, just getting in much more precisely.
That's the essence of it, getting in ideally right near the wick or the edge of the move rather than somewhere broader within the larger zone. That's the sniper aspect precision.
Okay, but refining down, zooming in like that, it can lead to a complication the video talks about, right? You might not just find one smaller zone, you could find several within the original big one.
That's a very common thing, yeah. As you look closer, you break down that price leg, and you might see 2, 3, maybe more little areas that look like valid supply or demand zones on that lower time frame, all nested inside the higher time frame zone.
So how does the source suggest you handle that? Which one do you pick?
Well, the video introduces this concept of the extreme zone.
The extreme zone. What exactly makes it extreme?
It's defined as the zone that's the furthest away from where the price currently is, but still within that original higher time frame zone and part of that key leg of price action, the strong push that created the zone initially.
Okay.
So if you're looking to buy from a refined demand area, the extreme zone would be the absolute lowest potential demand zone you identified inside the bigger zone.
Yeah.
If you're selling from supply, it's the absolute highest supply zone you found within the refinement.
And the video suggests maybe just placing your entry order, like a buy limit or sell limit, right at that extreme zone.
That's presented as a primary approach, yes. The rationale given is twofold. One, it offers the absolute best potential risk reward because your entry is the most, let's say, aggressive relative to the expected turn.
Closest to the potential reversal point.
Right. And two, it's often described as the safest entry point if you're using a passive limit order. Because the thinking is, if price breaks through the zones closer to it, it often makes a run for that final extreme level before it might potentially reverse.
So if it misses the first zones, it often goes all the way to the last one.
That's the tendency the source highlights for choosing the extreme zone for limit orders.
But, okay, there's a risk there, surely. If you only aim for that extreme zone, the furthest one out, what happens if price hits one of the closer zones you identified and reverses from there? You miss the trade completely.
Absolutely. That's the major downside of only targeting the extreme. You identified a valid area. Price might react perfectly from a zone slightly higher in a buy or lower in a sell. And you're left watching it go without you because your order was waiting way down at the extreme.
Does the source offer a way to deal with that, a way to potentially trade those closer non-extreme zones?
It does, yes. This is where it introduces what it calls the standard confirmation technique.
Standard confirmation, okay.
So the idea here is if price reaches one of those higher zones, let's stick with the buy example, so a demand zone that isn't the lowest extreme one, you don't just blindly put a buy limit there. Instead, you actively watch the price action on that lower time frame you're refined to.
You wait for a specific signal.
Exactly. You wait for a clear shift in the market structure on that lower time frame. A shift that lines up with the overall direction you expect based on the higher time frame analysis.
Can you give an example, like with the NZDPY case?
Sure. So price pulls back into, say, a higher 1-hour demand zone that you found inside the main 4-hour demand zone. You're watching the 1-hour chart. Price pushing down into that 1-hour zone. Now you watch closely. If, after entering the zone, the price then breaks decisively above a previous little swing high on that 1-hour chart.
Ah, like it stops making lower lows and lower highs on the 1 hour and actually makes a higher high.
Precisely. That break of structure, creating a higher high within the context of that 1-hour zone, serves as your confirmation.
So that little short-term trend change on the lower time frame basically confirms that the buying pressure at that specific higher zone is likely strong enough to turn price around.
That's the logic presented, yes. It suggests the institutional interest is genuinely active at that level, making it a potentially valid entry point, perhaps after a small pullback following the confirmation break. You don't have to wait for the extreme zone.
So it's a way to potentially get in earlier, although maybe the initial RR isn't quite as insane as waiting for the absolute extreme.
Exactly. You might sacrifice a bit of the maximum potential RR for a higher probability of actually getting into the trade if it takes off from a less extreme level.
Okay, that makes sense. We got refining zones handling multiple zones using either the extreme or confirmation. But the source includes a really crucial warning about not getting carried away with this, right? The danger of over-refinement.
Yes, this is a big one the video stresses. It explicitly warns traders not to go down too many steps in time frames during refinement. Like, don't jump straight from your 4-hour zone analysis all the way down to trying to find a tiny zone on a 5-minute or even a 1-minute chart.
But why not? Wouldn't finding, like, a tiny pinpoint zone on a 1-minute chart that sits inside a valid 4-hour zone give you absolutely ridiculous risk-reward, theoretically?
Theoretically, yes. And the source even mentions potential for things like 25R trades, if you could nail an entry like that.
Mm.
On paper, it looks amazing.
So what's the catch?
The huge practical problem highlighted is that the market often just doesn't reach those hyper-refined tiny little zones.
Yeah.
They are so granular, so precise, that the probability of the price actually trading exactly at that level becomes much, much lower.
So you end up missing the trade far more often, even if your overall idea from the 4-hour was spot on.
That's exactly the risk. You've got a great high-level analysis, you've found this theoretically perfect entry point, but price comes close, turns, and leaves without you, because it never quite tags your microscopic zone.
Makes sense. You sacrifice probability for potential reward, and maybe too much. Does the source give a guideline?
It does. It suggests a general rule of thumb.
Yeah.
Refine down 2 steps at most.
2 steps? Like what?
Well, the examples given were 4-hour down to 1 hour, and then maybe down to 30-minute. That's 2 steps. Or daily down to 4 hours, then down to 1 hour. Or maybe 30-minute down to 15-minute, then down to 5-minute.
Okay.
But importantly, it also points out that often just 1 step down is enough to get really significant gains in potential RR. Remember the NZDPY example. Going from 4-hour to 1 hour almost doubled the potential return from about 3% to nearly 5.6%.
Yeah, that's already a huge improvement.
Right. And the video noted even going to the 30-minute, the second step down, only added a little more, maybe up to 6% potential. So the biggest chunk of the benefit often comes from that first refinement step.
So the message is find a balance. Don't get so greedy chasing the absolute maximum possible RR on paper that you refine yourself right out of perfectly good trades.
That seems to be the core message, yeah. Maximize your potential, but keep it realistic enough that you actually have a decent chance of your order getting filled and participating in the move.
Right. So putting it all together then, zone refinement, based purely on what this source material presents, it's really a technique for taking an existing trade idea, one you've already developed based on higher time frames.
And then optimizing the entry point, finding a much sharper, more precise entry to potentially boost the risk-reward significantly without actually changing your overall target or the fundamental reason for the trade.
It allows for those sniper entries we talked about, getting in at a much better price within that broader zone of interest.
Exactly. And it's presented, as one specific tool or technique that would fit into a trader's larger overall system or approach. Not the whole system itself, but a way to enhance entries.
Okay, so this deep dive has taken us quite a journey. We started with those basic building blocks, the supply and demand zones from the source.
Moved into how refining those zones across different time frames is used to chase those more precise sniper entries.
Looked at how to potentially handle finding multiple zones after you refine using the extreme or waiting for that standard confirmation.
And crucially, landed on that important warning from the source about the pitfalls of taking refinement too far, of over-optimizing to the point where you miss out.
Right. Understanding these concepts, just as presented in the source, gives you a really clear insight into one specific way traders might try to maximize their entry points and potential returns.
It definitely highlights how looking closer, zooming in on the details, can potentially unlock significant advantages or at least perceived advantages in terms of risk-reward.
It really does hammer home that idea of zooming in. It kind of leaves you with a thought, doesn't it? If just looking one time frame closer, like from the 4-hour to the 1 hour, can potentially double your return on the same trade idea, what does that suggest about how focusing on finer details in almost any complex system, not just trading, might lead to dramatically different outcomes?
That's a great point. It raises that question.
Yeah, how do you figure out When you've zoomed in just enough to find those critical game-changing details, but not zoomed in so far that you completely lose sight of the bigger picture, the main opportunity itself. Where's that sweet spot?